Hi. Let's learn about floating rate funds. A floating rate fund is a fund that invests in financial instruments that pays a variable or floating interest rate. A floating rate fund, which can be a mutual fund or an exchange-traded fund, invests in bonds and debt instruments whose interest payments fluctuate with an underlying interest rate level. Typically, a fixed-rate investment will have a stable, predictable income. However, as interest rates rise, fixed-rate investments lag behind the market since their returns remain fixed. Floating rate funds aim to provide investors with a flexible interest income in a rising rate environment. Floating rate funds can include preferred stock, corporate bonds, and loans that have maturities from 1 month to 5 years. Floating rate loans are loans made by banks to companies, which are sometimes repackaged and included in a fund for investors. Floating rate funds can also include floating rate bonds, whose interest paid to an investor adjusts over time based on specific parameters. As interest rates rise, so does the return on the floating rate bond fund. The biggest advantage of a floating rate fund is its lower degree of sensitivity to changes in interest rates, compared with a fund or instrument with a fixed payment rate or fixed bond coupon rate. Floating rate funds appeal to investors when interest rates are rising since the fund will yield a higher level of interest or coupon payments. In evaluating a floating rate fund, investors must ensure that the securities in the fund are adequate for their risk tolerance, as floating rate funds offer varying levels of risk across the credit quality spectrum, with high yield, lower credit quality investments carrying considerably higher risks. Floating rate funds can include any type of floating rate instrument. The majority of floating rate funds typically invest in floating rate bonds or loans. Two popular examples of floating rate funds are the iShares Floating Rate Bond ETF, which seeks to correspond to the price and yield performance of the Barclays Capital US Floating Rate Note Less Than 5 Years Index, and the iShares Short-Term Corporate Bond ETF, IGSB, which invests in corporate bonds that are investment grade and have maturities of 1 to 3 years remaining. A money market fund invests only in highly liquid cash and cash equivalent securities with high credit ratings, offering high liquidity with a very low level of risk. On the other hand, floating rate funds carry a higher risk since they can invest in below investment grade securities such as loans. Money market funds typically pay a lower rate compared to floating rate funds. The credit risk of floating rate funds can be a concern for investors who hesitate to take on added risk to achieve that yield. Floating rate funds could have holdings that include corporate bonds that are close to junk status or loans that have default risk. Investors must weigh the risks and returns of each investment before making a decision. Here are 3 key takeaways. 1. A floating rate fund is a fund that invests in financial instruments paying a variable or floating interest rate. 2. Floating rate funds can include corporate bonds as well as loans made by banks to companies. These loans are sometimes repackaged and included in a fund for investors. However, the loans can carry default risk. 3. Although floating funds offer yields in a rising rate environment since they fluctuate with rising rates, investors must weigh the risks of investing in the funds and research the fund holdings. Hope this would help. Thanks for watching.